Today I'm delighted to be joined by Annette Tilbury, National Account Manager at Buy-to-Lets from West One Loans. And today we're going to be talking through the opportunities in buy-to-let post-COVID. Feel free to ask any questions during the webinar using the Q&A section that should be on your screen. You should see it below in the menu. And after the webinar, myself and Annette will respond live to as many of these questions as possible. But don't worry, if we can't get to yours, we will be back to you as soon as possible. My name is Kris Corns. I'm the Operations Director here at Crystal Specialist Finance, and it's safe to say that the last few months has been a challenging period for us all involved in the sector. That said, there are still some excellent opportunities out there, and working with the right partners and the right lenders can mean you can certainly maximise those for your clients. So very quickly, a little bit about us. We are dedicated solely to the intermediary market, and we are a multi-award winning business. We currently have over 80 lenders on panel with over 50 experts in the field working with us within Crystal, with therefore over 200 years combined experience. So when we talk about specialist, we like to think we know our stuff. And so does the industry. We've been lucky enough to be the recipients of many industry awards and shortlisted for many more during the course of the year. All of that is testament to the work that the guys do within the business in helping brokers like yourselves place cases for their customers. One thing we are particularly hot on at the moment is health and well-being. Hopefully you've seen this in the market press, the trade press. And the Crystal Solve Stress hashtag is one thing that we're really pushing at the moment. What we're saying here is it's a very pressing time. It's hard for everyone. There's pressures, there's health pressures, there's financial pressures, and also there's the pressure to work hard. And especially if you're working from home and you haven't done that before, you're trying to balance home life, work life. It can be a very stressful period. So what we're saying here is that we appreciate that, we understand that, and then over the period of the next 12 months, we are going to be providing helpful advice, both from our website and through various different medium that we'll be talking to you in, really promoting awareness of mental health within the intermediary sector. You know, we all like pressure, we all like to be working hard and feel like we're delivering, but we've got to be careful that we're not overdoing that, you know, there is a distinction between home and work, and that when we are working, we're offering 100% ability whilst we're working without burning ourselves out. So as part of that, you'll see that funky little amethyst sitting on the side there. If you submit an application to us and that completes pre-Christmas, then our Sales and Marketing Director, Jason, will have great pleasure in sending you one of our new amethysts, which are going down very well in the market at the moment. So just a little thing there, but hopefully that's something that can just make you think about your own mental health and well-being. At Crystal, we love technology. We embrace all forms of technology. We're using IP phones at the moment to make sure that we can deliver service while we're working remotely. We also love webinars, digital channels. Any way that we can communicate with you or with your customer is exactly what we're looking for at the moment. Times have changed. The world is different. We need to make sure that not only do we adapt to that, but we can also thrive within it as well. So we've got our video calls. We've got registers on our portal that we can send you updates, or you can click a callback. We have got our team, Sam, Alan, Dan, all of whom are available for phone calls. They'll respond to emails. They're also available for video conferences as well. So if you did want to speak to someone, or almost have that face-to-face interaction, but without any health risks, then by all means use that. So during COVID, as I've talked about, things have changed, and one of the biggest things that we're experiencing at the moment is timescales. I'm sure you'll all be seeing it yourself within the sectors that you work with day to day. We can't do anything about those. We've got enhanced relationships with a number of lenders, meaning we can get things through a little bit quicker, but it's not going to be groundbreaking. So the key thing for us is to ensure that we work with you to get that deal right first time. Let's make sure that when we are submitting a case to the lender, the documentation is correct, complete, and it all makes sense. So what we're saying at the moment is you can help us during this period in order to help your cases move quicker, so you can manage expectations with your clients as well. Ensure that we get as much information as we ask for, provide any relevant information and documentation from the start. Again, manage those expectations. We've seen from some of the high street lenders 19 days at the moment to assess an initial underwrite, which is crazy. We're not that bad in specialists just yet, but some lenders are touching on 8 to 10. So let's again ask as many questions as possible at the start. Get the ID documents, get the things you know you're going to need. There's no difference for you whether it's a specialist or a standard case. So, you know, still do your client onboarding, still get your ID documents, because we are still going to need those, and we'll get the other checklists out to you as quick as we can. And then lastly there, just be quick to provide any further info. Lenders are asking more questions. Lenders want to understand things like source of wealth. They want to understand exits. They want to understand the transaction a lot more. So there will be more questions to answer. So let's just make sure that we can cover those off quickly and completely as early as possible in the process. So today is specifically about buy-to-let. For us in particular, complex buy-to-let is where we specialise. Standard buy-to-lets you'll be doing yourself. You'll have your own avenues for those. Some of the sourcing systems are particularly strong in those areas. But for us, it's the things that fall through the cracks. It's things like limited company, HMO, mixed portfolios, and adverse credit. Things that are difficult and can be time-consuming in order to get placed. So, for example, you might be really comfortable doing a limited company buy-to-let. But what if that limited company doesn't have one of the standard SIC codes? What if it's a trading business that the client wants to utilise? That's where Crystal can really come into our own and help. So one of the lenders there, Foundation, in August of last year, so pre-COVID, but still give you a good idea of where the market was, shows that a third of landlords were planning to remortgage their portfolio, of which half would do so as an individual, and 19% of them will do so within a limited company. The others were undecided. And of portfolio landlords, so we're talking large portfolio landlords here with over 11 properties, 26% of them are likely to remortgage within a limited company. So over the course of the last 2 years, there's been a lot of talk about whether limited company is the best approach with incoming tax relief changes, the changes to the marketplace and how lenders are assessing cases. One thing that's become really apparent is there isn't a one-size-fits-all approach. What works for client A might not be appropriate for client B. And again, what we're seeing from our experience is if your client already owns a portfolio, they may have a different approach to someone looking to set them up for the first time. A remortgage might be a different approach to a purchase. And again, it's essential to remember that we are not tax advisors, and I'm sure many of the brokers listening today are not tax advisors either. For us, it's important that we signpost the clients in the right direction. We send them to their accountant to talk through this now. Otherwise, it could end up being a costly mistake for them further down the line. What we don't want is the client to take the wrong product because we think it's easier to process, only for them to be hit with a hefty tax bill in a few years. So it's very important, team up with an accountant, work with someone that you can pass clients between, that can give the client that advice and move it forward. So there's a number of things to consider, including the client's current tax position, their longer term tax implications and estate planning. What are the costs of transferring it into a limited company? Because generally, remember, it is a sale. An individual and a limited company are two different legal entities. The availability and cost of mortgage products. What's the long-term exit strategy? Are they planning to hold these or are they planning to sell? And what's the primary business plan? What's important for your borrower? Are they looking for the monthly income as an additional income stream? Are they looking to more towards property value accumulation? Are they looking to buy, improve and sell? Again, all of these could have different tax implications for the borrower. So it is essential that you do find a good accountant, team up with them to make sure your clients are protected. Again, it says there, you wouldn't want the accountant giving mortgage advice, and most brokers aren't set up to give tax advice either. And again, buy-to-let is considered a business now, not a hobby. So it's important that they do take this seriously and think about it as if they were looking to set up a new business. So here's a couple of examples for you. So property bought for 250k in 2001. It's gone up to 1.1 million in 2018 on these figures. Because purchasing it in a limited company would incur stamp duty, that was the stamp duty rate applicable at the time, and a capital gains tax bill as well, considering the individual is selling the property on. So the total cost of that transaction for the borrower is £320,000 from a stamp duty and capital gains point of view. So it would take quite a while to offset the tax savings against that initial outlay. However, there are areas where it does work. So the limits on mortgage interest relief, which we're starting to see now through the first set of tax returns, only apply to individuals. A company can still offset 100% of mortgage interest costs. Profits can be retained within the company. So if the client is looking to purchase more properties, then the profits can be reinvested for those purposes. Corporation tax rate is lower than that for individuals. So again, taking the money out of the company might be cheaper than taking the money personally, dependent on their personal circumstances. And again, dividend provisions mean that the first element of it is tax-free. So there's, as you can see there, it's not just as simple as doing in buy-to-let or doing in personal to get a mortgage product. There are various other things that need to be looked at as well. And I'm sure I don't need to tell you about the stamp duty holiday, but until the 31st of March next year, anyone buying a residential home will not pay stamp duty on any property worth less than 500,000. However, if you're buying a buy-to-let or you're purchasing a second home, then you still pay that 3% stamp duty surcharge. You don't pay the standard rate of stamp duty because it's exempt, but you do pay 3%. So there's still a big saving there for property investors up until March of next year. With lender timescales currently, valuer timescales, solicitor timescales, it is important that if clients are looking to get these through, they start thinking about that sooner rather than later, because before you know it, we're going to have Christmas on our hands. Then we've got the rush to get these completed before the stamp duty holiday kicks in. So let's ensure that if they are thinking of doing it, we can try and get them looking at it now. So HMOs, very topical area. It's something that lenders are still very, very keen to lend on, and it's still something that investors are very, very keen to get involved in. But there are caveats. So, for example, student-led HMOs, with the current climate, both with COVID and with university situations, are students taking up university accommodation at the same rates they were before? Do people have the same demand for shared residences that they had previously? So this is something that lenders are now questioning generally. When they see a new application come in, they want to understand how the transaction is going to work, what the COVID implications are, and how the transaction, what the lifespan of that transaction looks like. There are tenants in now, but what's going to happen next? Or if it's a brand new purchase or you're looking to convert, what's the rationale behind it? How is that going to work? So again, it's really important that you work with a specialist such as us and with a specialist HMO lender that can take a view on these things and can understand the whole transaction for the client. So again, when we are looking at buy-to-let underwriting, things are more tricky now because lenders want to understand the customer's whole portfolio. You see more and more lenders use the likes of eTech, where they can do a background assessment. They want to understand what spread of products they have and how highly geared it is. What's the customer's personal income position? You're probably seeing on all applications at the moment, lenders are asking about the impact of COVID. Have they had payment holidays? Have the tenants taken payment holidays? And what impact has that had for the client? Again, comes back to something I touched on earlier, where buy-to-let is now looked at as a business rather than being a hobby. Hobby landlords were generally living hand to mouth or just having a little bit of income from the buy-to-let. So therefore, if the client has a payment holiday or there's a void for a period of time, so if the tenant has a payment holiday or there's a void for a period of time, it can put a lot of pressure on the client's personal income situation. This is something that lenders are now looking to understand a little bit more. They also want to understand the returns model, rising tax costs with the tax implications. Is the model still sustainable? Does the tax code work? Are the customers correctly declaring the rental income? Do they have a long-term plan for it? They also look at asset liabilities, they look at cash flow, as well as the lenders having their own underwriting processes and procedures that we look for as well. Combine all that with the relative lack of products that we currently have and the timescales, it's a difficult area. Again, let's get it right first time. Let's make sure when we're submitting a case to a lender, we've chosen A, the right lender, B, the right product, and C, you're partnering with the right firm in order to get that dealt with. It becomes a more specialist product. The bridging market is still flying. As you'd expect, more questions, but it is still an area of growth. So a number of lenders now will consider buy-to-let bridging, where you take a bridge, you do a little bit of refurb, and then you hold it onto a buy-to-let. And again, with the purchase market the way it is at the moment, the market is awash with properties. There's some good opportunities there for your landlords to get involved and to improve some of the housing stock that they've got on their portfolio. So buy-to-let currently, highlights are on screen there. Products change fairly regularly, but loans from 25,000, we can do limited companies, portfolios, trading companies, all of the usual things you'd expect. LTV, you can go up to 85%, and rates are from 3.09 as it stands currently. Again, these are subject to change at very short notice, and we're seeing more and more change from lenders. Products are now only valid for a week, whereas previously they were valid for months. So again, pick up the phone, speak to our team, and we'll discuss what's available at that particular moment in time for you. So a couple of very quick case studies. So we had a guy owning 2 small buy-to-let properties in the southeast. He wanted more. So he found 4 up in the north of England, which had got excellent yields and were within his price range. So bear in mind, this is a standard buy-to-let landlord. He owns 2 standard buy-to-let properties. HMO, normal buy-to-let, a new build flat, and a flat above a shop. So the lenders that the broker went to were questioning, how is he going to manage these properties? He's got no experience of running a HMO or a semi-commercial property. And then to further complicate it, all 4 properties were under 75,000 each. So we got involved, we got to the bottom of the deal, understood what the client was doing, how he was doing it, why he was doing it, and we got a specialist commercial lender to take this, 3.89, 10-year interest only on the whole portfolio. Again, the specialist lenders take a manual view on things rather than it being a computer says no type tick box approach. They will try and understand what the client's looking to do, which means there's more avenues for what on the face of it is a very straightforward, very simple transaction that does make a lot of sense. Another one here for an expat landlord. We were approached by a new build broker. There's an expat teacher in Australia looking to purchase a property back in the Midlands. They were attracted by the yield, the quality of the property, and they knew the area well. Again, expat, new build, and Australia, all things that raise flags with a number of lenders. 75% LTV, 3.79 on a fixed rate buy-to-let. A large offshore registered limited company, so this was registered in the BVI, 3 directors in Singapore, looking to remortgage a 5 million portfolio, both to redeem the existing lenders, but also to raise additional capital in order to buy more properties. Added to that was the complexity to top slice in order to get the loan to be serviced. So we managed to get this on the full loan amount, using a lender that took a commercial view on the rent and the experience of the borrowers, and they even went as far as sourcing offshore opinion letters to confirm the structure and get to the bottom of how the company was structured and why. All of this completed in 3 weeks from application to completion, meaning the client could purchase quickly and take advantage of the opportunities that they'd seen. Now for us, we have various different ways of you contacting us. The key thing we want is engagement. So you can pick up the phone, you can send us an email, you can use our portal, our web chat, you can visit the office, obviously socially distanced of course, or you can join us on a number of events like this. All we want to do initially is to have a conversation about the deal you're looking to place. We want to understand, warts and all, what this deal is. What are the problems? Why are you struggling to place it? Why do you need specialist help? Once we know that, we've got much more of a chance of getting you the very lowest rate in the market. If you come to us and tell us it's a really straightforward buy-to-let and then we start finding out little bits through the process, it doesn't make for a great customer journey for anyone involved, customer, yourself, us. It's all about understanding as early as possible what the problems are. Let's face them head on and let's get it dealt with. The saying, eat the frog, comes to mind. Let's deal with the immediate problem, and then the rest of it becomes smooth sailing from there. So the process for us is really straightforward. Let's get an inquiry off you. Let's place that with our BDMs, our new business team. Let's get to understand that transaction. Once we've done that, we issue a quote. They find the most competitive, most relevant terms that we have available and send those out to you. At that point, if you're interested and your client wants to proceed, complete the application form, send that back. For us, that's all systems go from there then. That's when we start processing the case, credit searches, land registry, we start collecting income, we start collecting ID documents. We really put that case together, get that with the lender. And then very importantly, we also then work with the solicitors in order to get this case completed. We don't just wash our hands at offer. For us, if the case doesn't complete, if the funds aren't in the client's hands, we haven't done our job. So it's all about getting those funds released. So there you go, we've got the phone number, email and website all on screen for you at the moment, so you can make a note of all those details. And as I say, during the course of the webinar, please ask any questions that you've got. We're more than happy to answer them. I'm now going to hand you over to Annette, who will talk you through the West 1 proposition. Thank you, Annette.
Many thanks, Kris, much appreciated. Hi, I'm Annette Tilbury, National Account Manager for Packages at West 1 Loans. I'm presenting this webinar today in association with Crystal, and the topic we're covering is opportunities we have observed in the buy-to-let market post-COVID and how we can help you with these opportunities. So just a little bit about myself and West One. West One launched their specialist buy-to-let division a year ago now and have been working very closely with Crystal as one of our key packager partners. I personally have been in the mortgage industry for 35 years and I joined West One last December as the National Account Manager for Packages. So as we've all seen, there's been lots of uncertainty over the past few months, and this often brings opportunity, particularly in the specialist market where flexibility and pragmatism are really important for clients. So I will explore some of these opportunities with you today. Recent changes impacting the buy-to-let market. Well, we certainly have been hit with numerous changes over the years, so let's chat through some of these changes. Firstly, tax changes. We saw the mortgage tax relief phased reduction with the final phase kicking in this April. So now there's no deduction for any mortgage expenses from rental income to reduce your tax bill. Instead, you'll receive a tax credit based on 20% of your mortgage interest payments. This is obviously a lot less generous for higher rate taxpayers who effectively would have received 40% tax relief on mortgage payments under the old rules. We've also seen the removal of tax benefits for offsetting against your taxable income to try and reduce the total tax you have to pay, including the 10% wear and tear allowance that was allowable. We've seen the accelerated capital gains tax payment schedule, so effectively your tax liability is now due within 30 days of sale of a buy-to-let property, as opposed to previously it would have been via your normal tax return. The 3% stamp duty surcharge that was introduced on the 1st of April 2016, and it certainly created a lull in purchases after the initial introduction. We've also seen increased underwriting requirements, with the PRA introducing minimum ICR levels. Also, we are seeing lenders requesting business plans, cash flow forecast and asset and liability statements, just creating more work for everyone. Portfolio underwriting requirements, with some lenders using EDM and E-Tech systems to verify the client's portfolio data. HMOs, we've seen a huge amount of changes with new rules coming in, meaning that significantly more properties are now classed as a HMO. New licence rules came in on the 1st of October 2018, including minimum room sizes, maximum occupancy and disposal of waste rules. There was a revised HMO definition, which is 5 or more people forming 2 or more households, and an increase in the selective licensing requirements and areas that they're required in. Then we've seen the tenant fee ban come in for most private tenancies starting after the 1st of June 2019, and this applies to all tenancies after the 1st of June 2020, regardless of when the tenancy started. So this covers fees that are charged to tenants and their guarantors. Costs that were banned include reference checks, administration, credit and immigration checks, renewal of an AST at the end of the mortgage term, and as well as those, we've also had limits put on deposits that can be taken. So now the holding deposit can't exceed more than 1 week's rent, and for tenants' deposits it can't exceed 5 weeks' rent. So then, before the market has been able to digest the implications of Brexit and what that might hold, the COVID-19 pandemic has pushed all other considerations aside and really slowed the market and economy as a whole. The mortgage industry has significantly been affected by this, with repeated occurrences of lenders pulling products from the market, sometimes just days after they were first announced, or even a lender pulling out of the market completely. We've also seen government intervention with the banning of tenant evictions. So until the 20th of September 2020, you're not able to currently evict tenants. Until the end of March, renters will get 6 months' notice if their landlords plan to evict them. The industry has been hard-pressed to adapt to these changes of social distancing and lockdown, with valuations on hold. Progress of cases came to a halt for several months. We are adapting and evolving, and progress has been made to regain interest in the market with the recent stamp duty reduction. With a more upbeat mood, and we've certainly seen a lot more increased optimism with a large increase in inquiries. West One's take on the current climate. So the nature of how West One operate means that we're used to dealing with unique applications that may not fit traditional lending requirements. And throughout the pandemic, we've maintained lending during this time of uncertainty and upheaval. All our cases are manually underwritten, which means the underwriters get a very clear picture of the deal and they can make exceptions where they feel comfortable. We aim to work flexibly to find solutions to the challenges and complex situations created by the pandemic. It's been a tough few months, but we have definitely seen positivity and growth in the market in the last few months. So we will explore what opportunities this positivity can bring. We are cautiously optimistic with the buy-to-let market, and we have recently introduced most of our criteria that was in pre-COVID. And the buy-to-let market gross lending in 2019 reached 42.2 billion, which was 4.2% rise on the previous year. And up to the end of June 2020, the buy-to-let market is sitting around 18 billion of completions. So it'll be very interesting to see where 2020 ends up, but it's looking like around the 35 billion mark for buy-to-lets. So let's start looking at some of the opportunities we found ourselves with. Number one, I think we need to start with holiday lets, because certainly here at West One we've seen a huge increase in the number of inquiries for holiday let, Airbnb, short-term letting, and Crystal have definitely been providing us with lots of these. So landlords are reviewing their business plans and looking at ways that they can increase their income and reduce their costs. And with the COVID implications, many see that the rise in the staycation will increase demand for this sort of holiday let Airbnb type accommodation, which will in turn increase their income from the property when you compare that to what they would achieve via a normal standard AST. So clients should always seek the advice of an accountant, and things that they need to consider are planning and licensing restrictions. Furnished holiday lets still have some tax breaks that aren't actually available on a normal AST letting now. They were generally written on a more commercial basis, and so higher rates were applicable, but we're seeing the market become more and more competitive there. But few lenders still offer a simple solution. I feel personally that West One offer a very simple solution with holiday lettings. We base our lending on the AST rental return on a specialist product and our rates are very competitive, starting from 3.79. The property does need to appeal on an AST rental basis, although we realise that it is going to be let on a holiday let basis. And really, a well-run and busy short-term rental property can significantly outperform income from a normal AST. So there are huge advantages to landlords considering holiday lets, Airbnb type accommodation. Our second opportunity we're moving on to is expat lending. Again, another area where we've seen a huge increase in the number of inquiries, many looking to take advantage of the reduced stamp duty and expand their portfolios. West One are happy to look at citizens within the EEA. Any clients living outside the EEA would need to be referred for an agreement in principle up front. We do limit all expat applications to a maximum loan to value of 70%. It would sit on our specialist range. The applicants must own at least one buy-to-let in the UK with a mortgage and pay tax on that income in the UK. They must have a UK bank account, and they must also appoint a servicing agent within the UK to manage the property. So opportunity number 3, limited company lending. Again, another area where we're seeing a big increase. With West One, it can be a newly formed SPV or an existing one. It does need to be a special purpose vehicle. We always suggest that applicants seek accountants' advice to ensure limited companies are used in the right circumstances and for each client's situation. But as I say, we're seeing a big increase in these. And why might that be? Limited companies are often being set up for inheritance tax planning, with parents down as directors and often children as shareholders. And where we underwrite all directors and 20% plus shareholders, obviously if the children are put on with 19% or less shareholding, we don't require any information on them at all, but it makes it nice and simple to transfer property across to the children as they get older. We're also seeing more property owned in an individual's name being transferred to their limited company for the tax advantages that offers. Also, a lot of people aren't aware that for clients who have got trading companies, where we don't lend to a trading company, if they are to set up a subsidiary SPV, and that subsidiary has the same directors and shareholders as the trading company, under group relief rules that apply for stamp duty purposes, they wouldn't be liable for additional stamp duty on that transaction. So it is a good way of moving property from a trading company that we wouldn't be able to lend to an SPV without that extra tax implication. It's important that applicants get professional advice from their accountant regarding this to ensure it's appropriate for their circumstances, as West One are unable to offer any advice to clients on this matter. Also, with ourselves, our SIC codes need to relate to property management, investment or development. We don't have a specified number of SIC codes that we accept, provided that they meet that criteria. Opportunity number 4, we've got bridging and developer exits. So West One will look at taking out a bridging loan or lending on day one remortgages. We're seeing a lot of demand for developers where they're looking to retain some of the properties on a development rather than sell them all. Many lenders will look at clients owning the property for a minimum of 6 months. As a specialist lender, we will look at these on day one. Limited companies moving property to an SPV, they can also gift equity as well as use the group relief rules to avoid the stamp duty payments. And we're seeing more applications where applicants have purchased on bridging and needed to complete works, perhaps to make the property habitable. They're looking then for us to lend on the enhanced value after the works straight away. They don't want to have to wait perhaps a 6 months that some lenders would insist on, otherwise they base it on the original purchase price. With ourselves, we look at it based on the afterworks, clearly being able to see what works have been carried out to the property. Opportunity number 5, I think is quite an interesting one. We're looking at the more non-standard tenancies. So with ourselves, we're seeing an increased demand from unusual tenancy types. Majority of lenders perhaps aren't prepared to take on, and these have included your guarantee rent schemes, corporate lets up to 60 months, and then as well as these that we'll look at up to 75%, we've also been looking at the more unusual ones at a loan to value of 65%, where it's perhaps vulnerable tenants that have been put into a property. Often the charity, it holds the AST, and they're helping these people to get back into the community. Or we've seen ASTs from companies like Serco, who they're assisting with getting refugees into properties. So obviously these are a bit more unusual cases. They need to be referred to us for an agreement in principle. We would need to see the agreement up front just to make sure there's no onerous conditions and that we're happy with break clauses and such things. So any inquiries that you get like that, please do refer them across with as much detail as possible, and then we'll be able to confirm whether we're comfortable with the deal itself. I thought it would be worth just going over a couple of changes that West One's made in light of the COVID pandemic. You've probably seen that a number of lenders are digging a little bit deeper to ensure sustainability, and certainly the couple of areas that West One have are, we're looking closely at the payment holiday situation. So either the client can sign a payment holiday declaration to confirm they haven't taken one, or alternatively, if they have had a payment holiday, then it must have ended for us to be able to consider lending. What we would require is a letter from the lender confirming the payment holiday details. So that needs to include the date it started, when it ended, how much the payments will be restructured, and where applicable, the restructured payments will be used in affordability calculations. We also look for 2 months evidence of mortgage payments post-payment holiday via bank statements. We can make it a condition of the offer. So if, for example, they were due to make their first payment on the 1st of September, second payment on the 1st of October, that wouldn't be an issue for us. Also, we're looking for evidence of savings to cover rental voids. So generally we want to see 3 to 6 months savings to cover mortgage payments, 3 months where the property is already let and owned, or 6 months for purchases where the property is vacant. We may also ask for 6 months for holiday lets. If the valuer is to say that the property will have restricted appeal during the winter months, for example, then we perhaps would look for a longer period of savings rather than just 3 months, although we know it's let. Also, bearing in mind the eviction ban that's been in place and the recent announcement that landlords will require to give tenants 6 months' notice when they want to evict tenants, obviously you can see the reasoning behind that. I thought thought it would be worth just touching on a couple of limited edition products that we launched mid-August. The first one being our Max 250 product, which has got a lower rate than our core range. It does have some additional restrictions on that product. The maximum loan to value is 70%. We also restrict the property value to 400,000 on houses and 300,000 on flats. So you can see that on our standard product range, this particular product, the rate would be 3.59 on a 5-year fixed, as opposed to 3.85 on our core range that doesn't have the same level of restrictions. We also have a reduced ERC product, again another 5-year fixed, but rather than penalties applying for all 5 years, the penalties just apply for years 1 to 3, and the ERCs are 5, 4, 3% for those 3 years, with no penalty at all in years 4 to 5. This product was really designed for people who perhaps wanted a 2 or 3 year rate, but the rental calculation wasn't fitting, where most lenders are looking for 5.5% cover. We would be looking for 5%, but obviously that's more than would be required if it was on a 5-year fixed. So this makes the product very appealing to landlords that are looking for a bit more flexibility and don't want to tie the property up for 5 years. I just thought I would go over our lending limits. We are currently up to 75% loan to value for loans up to 500,000, 70% for 750 and 65% up to £1 million. So the maximum on a single property that West One will currently lend is £1 million, and that's the same as our current borrower exposure, £1 million per customer. One important point to note is we don't do cumulative lending. So in my example here, if you have got a client that's got 5 properties worth 250 each, we would be able to lend 200,000 on all 5 deals, whereas some lenders would cap that and say we can only do 2 deals at 75% because the 3rd deal will take it over the 500,000 limit. That's not the case with us, so it's just worth bearing that in mind. We do have a minimum loan size of 50,000 and a minimum property value of 100,000. What I love about West One's credit policy, I love the fact that if anybody has a default or CCJ up to the maximum of 350 and it hasn't been satisfied, we can ignore that. It doesn't matter when it was registered, it's just treated as a credit blip and we can just ignore it. Also, if somebody has satisfied CCJs or defaults, they can be considered even if they're fairly large amounts, provided we get a satisfactory explanation. The thing is, we won't accept any unsatisfied CCJs or defaults in the last 36 months. The other thing that a lot of people don't realise is that we can accept historic arrears. Our policy states that they shouldn't have missed a mortgage payment in the last 24 months. But if somebody went 2 down 26 months ago, they hadn't managed to bring the account back up to date, so it was still showing 2 down, with a satisfactory explanation, that would be acceptable to us. Also, late payment. So if somebody's made a payment within 30 days of the due date, we wouldn't treat that as arrears. So if the due date was on the 15th of the month, they paid the 14th of the following month, the credit search would show that they've gone 1 down, but provided we can get that evidence, we wouldn't treat that as mortgage arrears, which I think is very beneficial. We'll also look at 1 missed mortgage payment on any unsecured loan in the last 12 months. We won't accept any bankruptcies, IVAs or repossessions within the last 48 months. I thought it'd be worth going through some of our criteria highlights. So with ourselves, the minimum applicant is age 21. We may be able to look at second applicants being slightly younger, particularly if it's on a limited company application, but you would need to refer the details for our agreement up front. The good thing is we don't have a maximum age, so very beneficial if you've got older clients. It doesn't matter whether it's going limited company or in individual names. We do a credit check through Equifax, but we don't do a credit scoring. So that can be very beneficial if you've got clients with big portfolios, so they're regularly doing credit searches. That can often have a negative impact on their score, but obviously wouldn't impact ourselves at all. We don't have a minimum income requirement or evidence of income needed. The only time we might ask to verify income is if they're a basic rate taxpayer and they're looking to utilise our lower rental calculation for basic rate taxpayers. First-time landlords we can lend to, including HMOs and holiday lets, providing one of the applicants owns their main residence. We also look at let to buy and consumer buy-to-lets. We don't allow let to move, so we would require the applicants to be purchasing a new property. We also accept a maximum of 4 applicants, whether it's going limited company or individual. We offer a fast track remortgage service for individuals and simple SVPs up to a maximum of $750 loan amount. For standard properties and HMOs, for separate legal representation, we require 2 SRA partners and the firm must be registered with the Law Society. So as I mentioned, we have a lower rate for basic rate taxpayers. So you can see for our rental calculation, if it's a standard property, we calculate 125, and for HMOs, multi-unit blocks, it's 135. Limited companies, exactly the same, and higher or additional taxpayers, 140 on both. All 5-year deals are stressed at pay rate and all 2-year deals are stressed at 5%. But please bear in mind the completion fee is taken into account when we're working out the rental calculation, but this can be added to the loan over and above the maximum loan to value of 75%. Cases that we'll consider by referral. So we'll look at multi-unit blocks. Standard policy is 10 units. Anything over that should be referred to us for agreement in principle, along with your partial multi-unit blocks. So where somebody's sold off a number of the flats on long leases but want to mortgage the remaining freehold, please refer those across. High-rise flats above 5 stories, please refer those. Ex-local authority flats, including those with deck access. We are looking for the majority of the block to be owned privately, but please refer those for agreement in principle. Flats above or next to commercial premises, houses next door to commercial premises, again one of our strong points, but please refer them, they're considered on a case-by-case basis. Unencumbered properties or properties owned under 6 months, so day one remortgages we can look to do. We also will look at tenancy agreements with unusual occupancy types, so vulnerable tenants. These are looked at by case basis. Also, we've looked at cases where it's a Serco tenancy agreement and perhaps they're putting refugees in the property. These tend to be lower loan to value cases and again need to be referred on a case by case basis. We also look at properties non-standard construction, so your no fines concrete, easy form construction, etc. can be considered. One of our strengths is also interfamily sales or gifted deposit, gifted equity from immediate family members. We don't have a restriction on the maximum percentage. Again, we look at the individual case, so refer those across to us. expats living in the non-EEA countries, they need to be referred on a strong referral basis. Expats do need to have a credit footprint in the UK, so they do need to have mortgage payment history. We seem to be getting a lot of referrals where the property's owned unencumbered, they've been living abroad for a number of years, so don't have a credit footprint at all in the UK, and unfortunately that does give us a problem. So please try and find that out and get the referral across to us. But we have done cases in Australia, USA, Hong Kong, New Zealand, so various countries, so just get those referrals across to Crystal and they can refer them on to us. Finally, if you have any questions, please do contact Crystal on 01827 301 070, or you can contact me directly for any unusual inquiries, and then we can confirm whether they will be acceptable to us. My number's 07392 09 1019. Also, don't forget Crystal's website, crystalsf.com, where you'll find lots of very helpful information. Thanks very much for your time today, and we look forward to helping you as much as we can.
Excellent, thank you for that, Annette. Really interesting presentation there, I'm sure you'll all agree. So that brings us to the end of the standard section of the webinar. So myself and Annette will now respond to your questions. As I said earlier, don't worry, if we don't get to your question, we will come back to you and message you separately. Thank you for that, Annette. There were some really interesting topics in there. I particularly like the phrase cautiously optimistic about the buy-to-let space. I think that sums it up really well. Thank you to everyone for the questions that have been flooding in as well. We've had quite a few, and we'll try and get to as many of them as possible. Some of them have been responded to during the live webinar. So I'll cover those off as well, just so everyone's got the information there. So to start with then, self-employed with insufficient income, are you able to assist in those circumstances? Well, most lenders...
Yeah, that's quite a nice straightforward one for us.
Yeah, most lenders take a view on the rent alone, on the buy-to-let, without any minimum income in there. Yeah, there are lenders that will take a view on a range of other sources as well. Obviously, some lenders have got minimum income levels, some haven't. So really the key thing is let's have a conversation as early as possible. Let's understand the problem and we can try and work on the solution from there.
Yeah, exactly. Because we don't have a minimum income, and as you said, we're basing it on the rental. So actually, even if their income is fairly minimal, then that would be acceptable to us. Really, it's just a sanity check where the underwriter's looking at their credit profile. I had quite an interesting one this week where the guy only earned $3,000 a year and had over $60,000 on credit cards. And I said an acceptable explanation wouldn't be, well, he's living off his credit card. We need to understand that they will be able to maintain that. But yeah, we don't have a minimum. So as long as it stacks up, then that's fine.
And the same works the opposite way as well. Obviously, there are still lenders that will do top slicing. So if the rental income is a little bit short, there are options there to top that up if needed as well.
Yeah. Yeah, it's not something that since I started with West One last December, although we've said for high net worth individuals, we can look at top slicing, but it's never, been one that they've utilised. So I don't think it's, certainly in our market, it's not massive for us.
Excellent. We've had someone request further information on critical criteria, so hopefully Annette covered that during the presentation for you. If there is anything more you want on there, then please give us a shout, and obviously we'll share some of that with you as well.
Yeah.
We had a question looking for hints and tips to get involved and the opportunities within buy-to-let. Again, I think Annette covered off the opportunities available for people really well within that presentation. The key thing that we say is just spread the word among your clients. We give an example. A few years ago, we had a commercial transaction. We gave it a webinar like this, and one of the brokers in the room said he rented an office above a shop in a high street, and the tenant, the guy that owned the freehold, remortgaged the property elsewhere and went to a different broker and paid the commission and things for that. The broker that rented the office above did the guy's residential mortgage, he did his insurance, he did his pension, he did everything there for him. but the retailer didn't realise that he did commercial. So we went elsewhere, and of course the first question that new broker asks during the fact find is, can I have a look at your insurance? Can we have a look at your pension? Can we have a look at your residential? So we ended up losing a client in total because the client wasn't aware that he offered a solution for something that relatively is quite straightforward. So the key thing is speak to your clients, understand what they need, and then by all means speak to a specialist if it's something that you don't understand.
Yeah, I think you made a really important point at the beginning of the webinar when you were talking about seeking advice, and certainly getting tax advice and advice from an accountant, I would say, is crucial, because the number of times we see portfolios where people have merrily started off buying in their individual name, they've got a number of properties, and all of a sudden they then speak to the accountant who says, what are you doing? You should be doing it at a limited company. And then they've got to sort of unravel where they already are. So if you get that up front, and you gave a lot of tips about really thinking, what do you want to do? Do you want to build a portfolio? Is this just going to be an odd one property that you're going to buy? And those things are key on which way you move forward. So I'd say, yeah, get that advice up front, and then you'll make the right decisions rather than trying to sort of backtrack.
Excellent. We've had a question whether deals can still be arranged quickly in the current climate. Yes, it depends on what you're looking for, why and where we go with it. Lenders are running at various speeds due to various different reasons. The key is the quality of that submission. Let's make sure that when we get the information, as Annette touched on with some of the referrals, let's make sure that we can put a strong referral case in, that when we are discussing it with the lender, we know all the information up front. Otherwise, if things come out later, it's just going to slow the process down. And again, one of the biggest frustrations that all brokers share is lenders asking for information at various points through the process. Generally, in our experience, that happens because there's a question on one of the documents that we've sent. So if we can get all of that boxed off early doors, then it goes through much quicker. And again, things like bridging loans are still completing within a couple of weeks. So there are still options there to complete quickly.
Yeah, I'd say our turnaround times, we're doing pretty well at the moment. The one area I'd say that tends to slow things down are the valuations. And one key point I would say is, particularly if the property is already tenanted, put the tenants on notice, make them aware that a valuer is going to be arranging to view the property, because as soon as they've had that notice, because we get a lot of valuers asking, have they been advised, have they been given notice? And of course, if they haven't, they've got to wait that period. But certainly valuers seem to be very, very busy, so that's taking a little bit longer than we'd normally expect to see. But again, that varies from area to area.
Yeah, completely agree. Again, someone else asking if demand is still there for buy-to-lets. Most definitely. July was our busiest ever month on new business, even considering the current climate. We had more applications in July than we've ever seen as a business before. And I think that's one of the biggest factors that we're seeing with lender turnaround times. It is the volume of cases that are going in. I think people expected August to be fairly quiet, as traditionally it has been, and it just didn't happen. It was busier than ever before.
Yeah, we experienced exactly the same, and even into September. By the middle of September, we had already done all of what we had done in August, and yet August was virtually one of our top months. So, you know, it has gone absolutely crazy in the last few weeks. And one thing I just wanted to add, obviously, the webinar, we arranged that a few weeks ago, and only yesterday we announced that we're putting a pause on our holiday lets. So at the moment, we're not able to accept any holiday let applications. And ultimately, that is just because we've been completely flooded. I would say every other caller at least has been on holiday lets for probably the last sort of couple of months. So that market has just boomed. So we're just putting a pause on it, waiting for it to calm down a little bit, and then when we're able to, we'll reintroduce it. And of course, you'll be one of the first to know.
Excellent. We had a question about product transfers. How large is the product transfer market on buy-to-let, which I think Annette covered off in the chat. The figures are very much more difficult to get hold of. Most of the product transfer transactions go down as remortgages, which obviously blurs the figures a little bit there. What I have managed to find out quickly in the background is on the latest UK finance data, roughly 2/3 of all transactions have gone down as remortgages, with about 1/3 of them being as purchases. So it shows the size there that, 2 in 3 transactions that go through are remortgages. Whether that's with the same lender or with a different one, the data just isn't reported. What we have seen on there is that the specialist lenders have seen the biggest growth, which I thought was quite interesting, followed closely by building societies. So they saw 15% growth in 2018 in the share. And I think that just shows the flexibility of the product criteria, that they will look at the gaps, and as Annette's just touched on with holiday lets, can move very, very quickly, whereas a lot of the times getting a criteria change through one of the major lenders is a lot more time consuming. We had a follow-up question about expats, very topical question, with expats having their UK bank accounts closed as a result of Brexit. This is obviously due to passporting rules post-Brexit, and it appears to be country and bank specific. So NatWest and Santander, for example, have said yesterday that they've got no plans to close customer bank accounts, whereas other lenders, other banks, Lloyds, Coutts, etc., have said that they are closing them. It's an excellent question. It's one that I don't think we can particularly answer at the moment. We'll see more of that in coming months when lenders adjust their criteria. One thing that the regulator has said is that banks need to apply TCF, lenders, sorry, need to apply TCF to customers in those scenarios. So I think what we might see is different policies for existing customers. They might just allow that payment to be made by alternative means, an alternative bank transfer or changing the account somewhere else. For new customers, then that policy is still to be amended. It's one of the many challenges put on lenders at the moment. Obviously, timing is against a lot of them as well, making these decisions, as this is going through quite quickly. And we've had 2 new questions whilst we've been talking. Both of them are quite case specific, so I think we'll come back to these separately offline. However, one of them is about a property that's been untenanted for some time, as the client was unsure of their plans. They now wish to continue as a buy-to-let and want to raise a remortgage on it. So therefore, how would rent be evidenced given it's been untenanted for such a long time? I think the valuer opinion is going to be key on that one. Obviously, similarly to a purchase, it's going to be up to the valuer what that rental income is, and the lender will take a view based on that. So I think it would be considered in that way.
Yeah, and if it hasn't been let, then the underwriters will be looking to see that they can find that property being marketed. It is a condition of our offers as well that the property should be let within 3 months of completion. So the fact that it hasn't been, if they've owned the property for some time, then we would need an explanation as to why. But certainly, yes, that could be something we could look at. And just picking up on the other inquiry where they said that they purchased the property for cash 4 weeks ago, that's quite a good one as well for us, because we will look at properties that have been purchased cash. Quite often we see that they've bought them at auction because the property wasn't habitable, they've done works to them and they want to borrow against the enhanced value, and that's fine. We will look at those. We don't restrict like some lenders that they have to have owned it for 6 months, provided it's quite obvious that they've done works to the property. Or I had one yesterday where they were doing a lease extension because it only had 40 years remaining, but obviously that was going to enhance the value. They wanted to borrow against enhanced value, and that sort of thing's fine. But if it was just a case of they bought it at auction, did no work to it, got it for a bit of a bargain and were looking to raise against the enhanced value, we would just base that on the original purchase price if nothing effectively had been done to the property.
Yeah, and all of the examples that have been asked of us this morning are what we would class as straightforward cases. To most brokers looking at them, there's something quirky about them or something difficult with them. But for us, if you were to give us a standard buy-to-let, we'd be asking why we've got it. For us, it's about those little quirks and those things that are more difficult in there. We've also had the results of the poll come through as well from the wellbeing survey. So thank you to everyone that completed that. The majority of respondees are working between 45 and 60 hours a week at the moment, which is probably a sign of the times that are we working from home now or are we living at work? It depends on how you look at it. Certainly at Crystal, we've got a number of staff back in the office, but we still have the majority of our staff working from home. And I think we're seeing that across the board with a number of people. Actually, we've got 2 equal answers on the regular working week. How many days do you get enough sleep? So 20% of you have said 5 days, which is brilliant. And 20% of you have said 2 days. So again, it shows why we're doing this. wellbeing campaign, that we think that there's a lot more pressure on people now. There's a lot more pressure on mortgage brokers to try and keep the business afloat, to keep their clients happy, and to keep everything moving. How would you rate your overall level of contentment? Again, over half of you are moderately happy with how things are going. Excellent. And they go 12% if you love what you do and everything's progressing well. Perfect. Exactly what we want to see. And the three most important factors: happy relationship, financial independence, and fitness and diet. So we'll be sharing these, we'll be comparing these findings with the ones that we've had from the wider industry and sharing those further forward from there as well. So certainly thank you for all of your input there. It's going to form a really interesting document once we've managed to get the answers in from everyone. Anything else you want to add, Annette?
No, just thanks very much for your time. And yeah, any inquiries people have got, obviously contact you, and I'm sure you'll be able to place them.
We will. Perfect. Well, thank you for, firstly, thank you to Annette for the really informative presentation. There was a lot of good things to come out of there, and I hope everyone watching has picked up at least one good point from that they can take into their day-to-day life. And thank you to everyone for joining in today. I hope you found it useful, and if you do have any questions at all, obviously the webinar will be closed shortly, but please feel free to email us, info@crystalsf.com. We'll get picked up. Give us a call, 01827 301 070, and we'll be happy to answer any questions that you've got there. Look forward to speaking to you all again shortly, and look out for the next of the Crystal webinars. Thank you, everybody.
Thanks, Kris. Cheers.
Thank you.
Bye.